Thank you very much, Professor Greenberger. For my opponents out there who say that I haven't done anything in Congress, I appreciate what you said about my legislation being what caused natural gas prices to go down. I wish that I could say the same. I think it's extraordinarily. I don't know what the word is. I think that's a huge overstatement on your part.
So you're disabusing me of my admiration.
But I'm glad I got that on record, and I'll put it in my next commercial. I appreciate that.
I'll be happy to help you.
Thanks to Lydia Velasquez.
Now, I am a supply and demand guy. That's what I am. And the fact of the matter is, when you have speculators in the market that obviously take opposite positions, and when you have a futures market and oil, natural gas, whatever the case may be, is a commodity, just like corn, soybeans, which I have the majority of my experience in, wheat. And when you have consumers or you have even suppliers that are hedging, trying to lock in whatever price that they want, you also have to have an opposite position on that, which the speculators usually tend to fill that position. But my point is, too, speculators make money whether the price is going up or down. They bet on the trend. And I don't believe that they drive the price. Now, I do believe that speculation is the cause of volatility, which is what my legislation seek to address, is try to slow down volatility. In fact, I tried to put price stops in just like we have in farm commodities. That wasn't ended up being a part of it, to try to slow down volatility. But supply and demand, the fact of the matter is supply and demand is what drives the market. And while I would like to claim credit for gas prices, natural gas prices being so low, I do believe it's a fact of we had an extraordinarily mild winter, and so demand was very low, and we have some of the largest production. Given some of the new areas that we have found, we have a huge supply right now of natural gas, and I think that's what contributes to long-term pricing structure. Now, when it comes to crude oil, which is what the intent of this hearing is, again, I'm a supply and demand guy, and I believe in supply and demand. And when you increase supply, and if we can increase supply in the United States, it's going to have a dramatic effect, even if that supply isn't going to come to fruition for 10 years. You talk about, or you start opening up those regions, it's going to have a huge impact on the supply issue out there, and it's going to drive prices down. But I think it's very, very, and I would very much be interested in your comments on what I have to say about in terms of the volatility. Speculation contributes to volatility, but it doesn't contribute to overall price trends. And the fact of the matter is, and I'd like your comments on that too, speculators make money whether the price is going up or going down. They bet on that trend.
Chairman Graves, the crude oil market today, the futures market, is 80% speculative, 20% commercial. When it's said to small businesses, you go in and hedge, they aren't going in to hedge. Farmers, I'm sure in your constituency, will tell you it's too volatile to hedge. You control a contract with 4% of the value. On Labor Day 2008, the price of oil went up $19 one day and down $18 the next. You cannot hold a contract on 4% margin. The commercials, and you should talk to people in the Commodity Market Oversight Coalition made up of heating oil dealers, the New England Fuel Institute, Petroleum Marketers Association, the airlines, the truckers. They all believe that when you have a futures market that's 80% speculation and 20% commercial, you're not having those speculators help the commercial. They're dealing with each other. Now, you say they make money when the price goes up or the price goes down. They offer $500 billion of bets. You can only bet the price will go up. To offset those bets, they have to buy long. Now, the fact that there's an opposite side to that bet, it's like there's an opposite side to the stock market bets, too. But stock market prices just don't go like that. They can go like that. When there are more people selling, trying to buy it than sell it, yes, people will meet it, but the price goes up. If you took that $500 billion out of this futures market, it would decrease not only the price of crude oil, because the betting is on a basket of commodities. Natural gas, by the way, is only 4% of it. Oil products are a huge percent of it, but so are farm prices. And you go talk to farmers or related industries, and they'll tell you, small farmers, they cannot use futures as a hedging vehicle. The market has passed them by. They are not hedging. And what does that mean?
I completely disagree with you. Absolutely, emphatically disagree.
Well, I appreciate that.
And in every futures transaction, you have to have an opposite position. And if an option is exercised, you have to have an opposite position.
For every stock sale, you have to have an opposite position. But stocks go up and down. And if people are buying Apple—
We're not talking about the stock market.
Well, it's the same market fundamental in futures contracts.
Mr. McNally, I'd appreciate your comments.
As I said, since the late 1800s, producers and consumers have understood that oil prices tend towards wild gyrations. And we should differentiate here between volatility, day to day, week to week, and then gyrations, huge swings. Economists call it low price elasticity of supply and demand in the short run. Plain English, you got to use oil. Price of chicken goes up, you buy meat. Price of gasoline goes up, you still buy gasoline. So you need big price changes to effectuate little changes in demand. And that's why throughout history there have been three groups that have tried to suppress this volatility on the producer side. Rockefeller and Standard Oil in the late 1800s, which we busted up in 1911. And then we were the most effective OPEC. We, the United States, the Texas Railroad Commission, Seven Sisters, locked up, stabilized the price of oil for 30 years. We handed over to OPEC in March of 1972. The chairman of the Texas Railroad Commission, they met every month to set production quotas just like OPEC has, and he called it a damned historic occasion. Why? Because for the first time in 30 years, the U.S. didn't hold any spare back. We let it all go because demand was outstripping our net supply growth, and OPEC took over. In 2008 was the first time we saw since March of 1972 the spare capacity holder, now Saudi Arabia, no longer Texas Railroad Commission, run out of spare capacity in peacetime. You can read the DOE reports from earlier this year. If we're looking at a very tight market with a very low shock absorbing buffer, with a war with Iran on the head, possibly for the summer, a risk that is being alluded to by comments from senior officials such as Secretary Panetta, people are going to speculate on prices going a lot higher. And I think it's important to differentiate and define speculation very carefully. If I'm having a picnic near the railroad tracks on a sunny day with my family, and I see two train cars coming down that railroad track on the same track heading towards each other, I'm going to speculate on a train wreck. I'm not causing the train wreck, but I will speculate with high conviction we're about to have a train wreck, and I want to move my family away from the railroad tracks. And that similarly goes into price formation in oil. Oil prices are driven by supply and demand, as you said, in terms of data and the best we can perceive them. There's a lot of work to do to improve that. I think we'd all agree. But also expectations of future supply and demand and supply risks. And we are in a tight and fearful market, and as long as this market remains tight and fearful, we are going to see high volatility, or as I prefer to call it, gyrations in prices. Thank you.